Hey guys, Doug the Retirement Guy here. We've got a new series that we're doing. It's called the Bond Fund Reviews. And what we're going to do here is go over a bunch of different bond funds. Since the stock market's had its ups and its downs, we look at a lot of retirees are always being told, put your money in the bonds, put your money in the bonds. And so we wanted to take a look at some bond funds and see which ones would be the best for our retirement funds. So let's get into it today. Before we do that, I want to thank you for hitting that subscribe button and hitting those likes buttons. Definitely those comments you guys continuously make. We're here to help you try to grow your money and to grow your retirement. Today we have Angel Oak ETF CARY. Angel Oak's company, fairly good in the bond market, shows a dividend of 5.02. Now, Carry is really pretty much a little bit of a different operation. Is they're trying to do the best risk to adjustment opportunities on fixed incomes. So they're looking for stable income, but they're also looking for some price appreciation as well. So they're trying to do it in both ways. Their distribution of 502, their 30-day yield of 5.3 shows you that they do have a steady cash flow. The one thing I don't care for them right off the bat is that 1% expense fee. It just seems extremely high for a bond fund for what you're doing. And when I look deeper into this, I finally realized what's going on is that they're not just doing bonds as a whole, they're also buying a lot of different bond funds. So let's look deeper in their holdings. They have holdings of 583 different organizations. I put basically the top 10, top 5 on the board. And when you look at this, first off, they're into government obligations, big part of that, which is very, very comfortable. And you can see they go all the way out to 2030. But then they get into iShares, high yield corporate bonds. They get the Spider high yield bonds, the Fannie Mae, which is the home mortgages. So there's a lot of different markets that they get into. They're also into the automotive type thing, which gives them a higher interest rates. So just a lot of different things that they do into it versus just doing standard government type bonds. When I look at their breakdown of their holdings, it really shows that they are well diversed. And the credit side of it, which is the one that got me, is when I took a look at this, if you understand bonds, everything basically A's are, they call investment style. Even the BBB is really classified. It's right on the border. It's like the last one for investment style. After that, they call them non-investment. That you always hear the word junk bonds. That's what they're talking about there. And if you look at this company, pretty much 75% of their bonds are investment grades from the AAA all the way down to the triple B. And then the other one that I look at always with bonds is two things. And is what is the interest rates that overall that they're collecting, and you look at this and they're looking at 6.04%. Their average yield at maturity is 6.36, which is, you're going to have a little bit of rollover into that point. And then duration, this one has a shorter duration as of 3.27 years, when we see a lot of funds are probably in that more that 4, I'll call it 3 to 5 years, what common thing is, normally hitting right in the middle of 4 years. So at 3.27, it's a little bit short, but overall high grades, really strong funds across the board. So why carry? Well, first off, the really should say is why bonds in the first place, and that is bonds are smooth over time. They stop the roller coaster of the up and downs markets. Now, in the past 2 months, March and April, we have seen dramatic roller coaster rides. And bonds will take you out of this. So when you get into retirement or preparing for retirement, bonds are a way to put some money away and that you can set it and forget it and not really worry too much about it. It's the safety. It's investing in high level rated bonds gives you that safety for retirement. Couple other videos that we've done, we always tell you that you take your cost of living and you want to put in secured funds. This is where we're talking about. This is where you want to put your money for safety, put it away this way. The returns of 5.02 and the 30-day SEC yield, very common. very steady. And you can see the company is getting that 6%, and taking the 1% off the top, you're getting 5. So very, very easy math to figure out accordingly. And the thing is that we love about it is it's still a monthly dividend payout. And if you know this channel at all, you know we love the regular cash flow of monthly payouts so that we can set up our budgets, we can pay our bills, and we can live comfortably off of the money coming in and know it's coming in every month. Now let's take a look at the return of carry, and this is what the market really show you is right now, prior months, the month of April, this is technically going to be the month of March, you can see they were flat in the month. But then when we go to the year to date, you can see that they're about a 2%. You always want to look at the gray one. I know it's a little confusing, but you look at the gray one, they're up about 2% for the year. So 4 months into it, they're up 2% with 2 bad months attacking us. So not bad. 1 year, they're showing an 8% return. So very, very solid. I'll give you the next one is the light blue one, the very last tower that's there. That is the industry average of bonds. So you can see average bonds about 4.5. These guys are hitting the 8%. And since inception, they're just cranking out 8%. So it is fairly new fund, but not uncommon for bond funds to be fairly new, starting off with a solid platform. Dividend chart. Now this is one here, if you look at the dividends, January 23 to January 25, so we're about 2 years into this fund, and a fairly steady payout right above that 10-cent line that they've been paying. One little blip in January or February of 24, but you look at January 25, they did a huge distribution correction and payout. So it really gives us an average about 11 cents per month per dividend stock. So very, very solid 11 cents carry all the way through. Now what we did here is we took ourselves and did a $10,000 challenge that we take $10,000, invest it into the fund, and April 24 of 2024, the fund was selling at $20.35. So 10,000 into it gave us 491 shares. You go a year out, and I like to do this in 2 different ways. The first one is going to be, if you look at this in March 3/21, the price of the stock was $20.83, which was basically up 2.38%. You get into April with the tariff crash that every stock, I don't care who you are, was affected by the giant drop off of April. You see this one dropped down, almost cut the 1 percentage point off of it. But still, with all the negatives that's come down, this fund still has been able to generate 1.28% or $127 off of that $10,000 investment. Very strong for a fund, and that's why they go back and say that they are trying to get appreciation of their stock and pay a fair dividend. When we look at the dividend, they're paying 6.67. Now that's not a mistake. That is actually taking what you would actually have received in the past 12 months and got your dividend. So it's higher than what they're projecting. So the return on this carry is $794 over 12 months, or 7.95%. That, guys, would be a very strong number if this was a stock fund even. But this is a bond fund. So this is one of those set it and forget it, and I'm going to get 6.67% over a year. Not bad at all. Now we look at the adjustments over time, and the carry is pretty steady. And right now is what we're really looking at. The average price, the 52-week average price is $20.78. You see in September, it had that big pump up to the 21.20, came back down, but it's kind of steadied itself out at $20.78. The current price of $20.61 is basically 0.82% below average. So if you bought the stock today, you still have almost 1 percentage point of growth should come just for it to get back to normal. Then we take a look at that March and April drop off. And this is what we want to do. How did these bonds handle 2 months of back-to-back just pure garbage out there? And the March high was $20.81. The rock bottom that they hit was almost today at $20.61. So that's basically a 0.96 drop when the markets were down 10 to 16%. So these things did not move. Kerry did not make any real adjustments. And you look at the line, and really, there's not much movement across that board. So again, solid account. So basically a recap of what's gone on in the past. 1 month out, Kerry was negative 0.72, while the S&P was down 5.27. 6 months down, Kerry was down 1.34% when the S&P was down 5.97. Year to date, they're up a half a percentage point when the S&P is down 6.91%. So the fund is definitely beating the S&P 500, which is the baseline for most stocks and markets out there. So guys, I give you the little character. There's no roller coaster ride here. You're not going up and then going back down and spinning yourself all around. This is actually what we just call just smooth sailing. Set it, forget it, and let it run. So in summary, in 12 months, you've had a 1.28% growth. Can't beat that. You got a dividend rate of 6.67. Again, very solid. And a total return of 7.95%. So you got a nice dividend to give money that you can live off of. You got a little bit of growth off of it in some bad times. 2 out of the past 4 months have been negative. This one's staying positive. Do you put all your money into this? No. You put a nice chunk of the money into this for security, and you let it ride. So is this good for a retirement account? And the answer is most definitely. Morningstar has a very low risk. You have a 6.67 dividend. Your NAV is growing over troubled times, which is unheard of in today's market. So we put this as a moderate buy. This is where you want to put some money into it and say, hey, let's go. Let's take some of our securities, put it away. And you wouldn't be sitting there saying, do I sell when it's at the bottom? Do I try to reinvest? What do I do? This is a set it and forget it type program. Guys, this is Doug, the Retirement Guy. I hope you like our new series going over bonds, trying to help you in the market that's troubling. If you like what we're doing, give us that thumbs up. Don't be afraid to hit that subscribe button. Don't miss all of our videos that we have going. And if you like it or dislike it, leave a comment. Tell us what you like, don't like about it. Everything helps the channel grow, and that's what we're here for. I appreciate it, and we'll see you at the next video.